Sigma Lithium missed consensus EPS estimates this morning. They reported a 2-cent loss per share.
Right, and analysts were looking for a 15-cent profit there. I mean, it's a sharp improvement from the 17-cent loss we saw a year ago, but still a miss.
Exactly. But the revenue side is completely different. They beat the Zacks consensus, coming in at a record $54.7 million.
Which is just massive. That's up like 223.8% year over year from Q2 of 2025.
Yeah, a staggering jump. Though I should mention they did miss the broader institutional whisper numbers. Those were hovering between like 65 and $68 million.
Right. And then for guidance, they actually lowered their full year 2026 all-in sustaining costs, or AISC, down to $668 per ton.
But they also pushed the completion of their Phase 2 capacity expansion all the way to the end of 2027, and Phase 3 is pushed out to 2028.
Yeah, that delay is huge. And the stock reaction was brutal. Shares fell 4.49% to $15.73 right after the report.
I mean, that drives them down over 14% year to date, and it was mostly driven by news of a temporary suspension of operations.
It really is one of the most paradoxical earnings reports of the quarter for anyone watching this space.
It's just super weird, right? For you as a retail investor looking at this, how does a company post a massive 224% revenue bump, print record profit margins, and just show flawless unit economics, but the stock drops on earnings day?
It makes absolutely no sense on the surface. You've got an operation that just hit 35,400 tons of lithium oxide concentrate production in the second quarter.
Right, which is a 52% sequential increase.
Exactly. I mean, they beat their own 33,000-ton guidance by 6%.
So to figure out why the market is aggressively hitting the sell button today, we really have to look at the operational execution at the Grota do Cirilo complex in Brazil.
Yeah, we have to figure out where that record revenue actually came from and then kind of tear into the corporate structure to find where the risk is hiding.
Let's start with those operational numbers because honestly, out of Grota do Cirilo right now, they're staggering for a mining operation in this macro environment.
Oh, totally.
Yeah.
It isn't just that they pulled more rock out of the ground, It's the profitability profile of that rock.
Right. They posted a 60% gross margin, a 32% operating margin, and this is the wild one, a record-adjusted EBITDA margin of 47%.
Seeing a 47% EBITDA margin in the hard rock lithium space right now is virtually unheard of.
Yeah. And just as a quick refresher, EBITDA, so earnings before interest, taxes, depreciation, and amortization, gives you a really clean look at the cash-generating power of the core business.
Right, before the accountants start moving things around. It just shows if the actual physical process of mining and selling lithium is fundamentally working.
And the unit economics completely explain the mechanics behind that cash power.
They do. Their plant gate cost, like literally the cost to blast, mine, process, and stockpile the product right at the gate of their facility, dropped to $401 per ton.
Wow. And then when you add CIF cost, insurance, and freight to get it onto a ship and over to the end customer, it only bumped up to $452 per ton.
Which is crazy because that represents a unit cost reduction of over 30% in just a single year.
Meanwhile, they're managing to realize a lithium price of $2,089 per ton for their SC5 grade concentrate.
Yeah, and let's just pause on SC5 for a second. That stands for spodumene concentrate at a 5% lithium oxide grade, which, is the standard benchmark in the industry.
Right, but the spread here is what's absolutely wild. They are producing and shipping this heavy raw material across the globe for $452, and they're selling it for over $2,000.
Yeah. Management was heavily pounding the table on the call about the catalyst for this margin expansion. They kept calling it the primarization of their mining operations.
Primarization, which sounds like a word a management consultant invented to bill an extra 50 grand.
Huh, exactly. But the underlying mechanic is just fundamental resource economics. It literally just translates to insourcing.
Right. They stopped renting other people's equipment and contracting out other people's labor. Let's frame it like, imagine a popular local restaurant that relies entirely on third-party delivery apps.
Right.
The restaurant is doing incredible volume. The kitchen is cooking nonstop, but they are paying out like 30% of every single order to the delivery platform.
Yeah, and taking a massive cut.
Yeah. So suddenly, the owners decide to fire the apps. They buy their own fleet of delivery cars, hire their own local drivers, and overnight, their profit per meal just skyrockets because they control the whole vertical.
That's a perfect analogy. Sigma effectively did exactly that with their earth-moving and mining fleet.
By removing the third-party mining contractors and deploying their own high-efficiency fleet, they stripped out the entire contractor markup.
Yeah, that 30% profit margin the contractor was taking just to operate the bulldozers and crushers, Sigma just captured it for themselves.
But I have to push back a little on the sustainability of this. I mean, the lithium spot market is historically
Oh,
vicious.
absolutely.
We literally saw battery-grade lithium carbonate prices fall to $8 a kilogram earlier in 2025 before rebounding to over $25 recently.
Right.
So are sub $500 CIF costs something we can actually rely on? Or did they just have a perfect quarter where fuel costs, currency exchange, and ore grade all magically aligned for them?
Well, I mean, a perfect storm of variables always helps in mining,
Mm-hmm.
but the structural cost advantage they built here is permanent.
Really? How so?
Let's look at the global hard rock lithium cost curve. That curve maps out every producer in the world for the absolute cheapest to the most expensive.
Right. Okay.
Achieving a $452 CIF cost places Sigma firmly in the bottom quartile of global producers.
Meaning they are among the cheapest 25% of operators on Earth to pull lithium out of a rock?
Exactly. And that creates this tremendous defensive moat. When lithium prices soften, and they always do, it's super cyclical, the producers in the top quartile start bleeding cash.
Right. The ones spending like $1,200 or $1,500 to produce a single ton.
Yeah, they have to physically halt operations because every ton they sell loses them money. But at $452, Sigma can survive price crashes that would literally bankrupt their competitors.
And still generate positive cash flow while doing it.
Exactly.
So if you can pull lithium out of the ground that cheaply, the next logical question for you as an investor is how do you maximize the value of that cheap capacity? Like, who are you selling it to tomorrow?
Right, and that brings us to the narrative shift. On the earnings call, CEO Anna Cabral-Gardner made this massive pivot.
Yeah, she essentially stopped talking about electric vehicles entirely and tried to reposition Sigma as an AI enabler.
It's a fascinating narrative. She drew this direct causal line from Silicon Valley data centers straight to the Brazilian dirt.
Which sounds like a stretch until you look at how AI data centers actually tax the electrical grid.
Exactly. Generative AI models require just immense, constant baseload power. I mean, a single query to a sophisticated language model can use 10 times the electricity of a standard web search.
Wow. And you cannot run a billion parameter AI training facility on intermittent wind or solar without substantial energy security.
Right. If the wind stops blowing, the AI training run fails.
Yeah.
You lose millions.
So that energy security requires massive grid-scale battery storage infrastructure just to smooth out the renewable power generation.
And that battery infrastructure fundamentally requires lithium. The macroeconomic data management cited to back this up is super aggressive too.
Yeah, they forecast global lithium carbonate equivalent, or LCE demand, leaping from 1.5 million tons in 2025 to 5.0 million tons by 2035.
And to contextualize that 5.0 million ton number, look at Sigma's ultimate best-case scenario production target.
Right. They eventually want to produce 830,000 tons of concentrate by 2028.
Yeah, and even if they hit that monumental target, they would still only supply roughly 2% of global demand.
The pie is just growing so fast that even the largest capacity expansions only capture a tiny sliver of the market.
Exactly.
But I gotta be honest, slapping the letters A and I onto a mining operation feels incredibly cynical to me.
Oh, for sure.
I mean, every company on Earth is trying to shoehorn artificial intelligence into their earnings calls right now to force a multiple re-rating from Wall Street.
Yeah, everyone wants that tech valuation.
But a hard rock mine in Minas Gerais is not a tech stock. Are we really supposed to buy a lithium mine as an AI play?
Look, the skepticism is completely validated. But if you look at the second pillar of their marketing strategy, it reveals the financial engineering behind the narrative.
You're talking about the quintuple zero green lithium premium?
Yes, they are leaning so heavily into that.
Let's actually list those 5 zeros out because they are technically impressive for a heavy extractive industry.
Go for it.
Okay, number 1, zero tailings dams. Number 2, 100% renewable energy powering the processing plant.
Right. And number 3 is zero hazardous chemicals used in the processing.
Oh, and number 4 is wild zero drinking water usage. They literally use sewage water for the plant.
Which is amazing. And the 5th is safety. Over 1,100 days with zero workplace accidents.
Right, so you combine that quintuple zero status with the AI data center narrative, and you get their recent addition to the Morgan Stanley National Security Index.
Yeah, and that index specifically tracks companies that are critical to supply chain resilience and strategic infrastructure for the West.
Okay, I understand the PR victory of a green label, but how does an index inclusion translate into actual shareholder value? Like, why does Wall Street care if a mine uses recycled sewage water as long as the cash flow is strong?
It comes down to the rigid mechanics of institutional capital. Mining juniors traditionally attract a very specific, speculative, volatile pool of retail investors.
Right, high risk, high reward traders.
Exactly. But sovereign wealth funds, massive state pension funds, and dedicated ESG funds, they operate under strict, legally binding mandates.
Okay.
So a $50 billion European pension fund literally cannot invest in a mine that uses tailings dams or burns coal, no matter how attractive the EBITDA margin is.
Wait, really? So a massive sovereign wealth fund has their hands tied? They couldn't buy a cheaper, dirtier mine even if they wanted to maximize
Nope,
returns.
their compliance departments would block the trade instantly. By hitting all 5 of those zero metrics, Sigma essentially creates a VIP pass into a vault of trillions of dollars of sticky long-term capital.
Capital that standard mining companies are completely blocked from accessing.
Exactly. By landing on these thematic indices, Sigma is intentionally trying to swap out their volatile retail investor base for massive institutional anchors.
And that stickier capital theoretically reduces stock volatility and supports a much higher valuation multiple over time.
That's the playbook, yeah.
So the Green AI label isn't just a marketing brochure. It is a highly calculated capital market strategy.
Completely.
But this brings us to the harsh reality of why we are even having this conversation today.
Yeah, stock chart.
Right. The stock did not go up today. It dropped 4.49%, bringing it down 14% on the year. How does a bottom quartile cost producer with a VIP pass to institutional capital suddenly hit a wall like that?
Well, the wall is made entirely of regulatory friction and liquidity constraints.
Yeah, the primary risk and the direct catalyst for today's sell-off is a sudden, temporary suspension of their mining and processing operations in Minas Gerais state.
It's a suspension over environmental claims from local regulators. And management was incredibly defensive on the call today.
Yeah, they kept calling the claims unsubstantiated. They mentioned they are actively negotiating a TAC agreement to resolve it.
Right. A TAC is a Termo de Ajustamento de Conduta, essentially a legally binding conduct adjustment term under Brazilian law.
And they're hoping to restart operations in 1 to 2 weeks.
Which, 1 to 2 weeks sounds like a blip on a 10-year chart. But in the mining sector, an abrupt regulatory halt shakes investor confidence to its absolute core.
Because when the crushing machines stop, the cash flow stops instantly.
Exactly.
And the irony here is thick enough to cut with the chainsaw. I mean, they are marketing themselves as the pristine, ultimate quintuple zero green lithium producer.
Oh, it's so ironic.
They are theoretically doing everything right by the environment, avoiding toxic chemicals, preserving drinking water, avoiding catastrophic tailings dams.
Yeah.
Yet the very thing halting their stock right now is an environmental dispute with local regulators. It's mind-boggling.
It really highlights the vulnerability of operating in complex regulatory jurisdictions. You can have the best environmental technology in the world, but if local regulatory bodies are bogged down in red tape,
Or if there's political friction at the state level.
exactly, your high-tech operation still gets a padlock put on the gate. It's a classic battle between long-term operational excellence and short-term regulatory panic.
And the panic is justified because of the cascading effects of a shutdown.
Oh, big time.
Due to this suspension and the immediate need to preserve capital, management announced severe delays to their expansion plans.
Yeah, Plant 2, which is supposed to be the next big growth engine, is now pushed to the end of 2027.
And Plant 3 is pushed all the way out to 2028.
Those delayed timelines cascade directly into liquidity stress. I mean, Sigma generated $27 million in operating cash flow in the first half of the year, which proves the underlying asset works.
Right.
But the corporate entity is operating with a deeply concerning current ratio of 0.32.
Let's clearly define what 0.32 means for you as an investor holding the stock. The current ratio measures a company's ability to pay its short-term obligations.
Right.
A ratio of 0.32 means that for every dollar of liabilities or debt coming due within the next 12 months, Sigma only has 32 cents in liquid assets to cover it.
Which is a remarkably tight spot for a company boasting 47% profit margins.
Yeah, where is all that cash going if they only have 32 cents on the dollar? How is a company this profitable suddenly cash-strapped?
It's being completely devoured by capital expenditures and debt service. Building hard rock lithium processing plants requires hundreds of millions of dollars up front. They are trying to fund the massive capex requirements for Plant 2 and Plant 3 while simultaneously servicing the debt they took on to build Plant 1.
Ah, so when your current ratio is that far below 1.0, uninterrupted cash flow from operations isn't just a nice to have, it is vital oxygen.
Exactly. They need every single ton of concentrate to be mined, processed, and sold exactly on schedule just to keep the lights on and the banks happy.
Which entirely explains why a, quote, temporary 1 to 2 week operational halt is a glaring alarm bell for institutional investors.
Yeah. If operations are suspended and revenue stops flowing, that 0.32 ratio becomes a ticking clock. They cannot afford delays.
Because pushing the completion of Plant 2 and Plant 3 out by years means the expected revenue from those expansions is also delayed.
Right, forcing them to survive on just Plant 1's cash flow for much longer than they originally modeled.
The split-screen reality of this company is just fascinating. On the operational side, you have a literal masterclass in unit economics.
Yeah, they insourced their mining, bought their own fleet, drove costs down to $452 a ton, and posted margins that are the envy of the entire commodity sector.
And they've positioned themselves perfectly to capitalize on the macro demand surge from AI data centers and global energy storage.
But on the corporate side, they are walking a tightrope without a net.
Yeah. They are trapped by local regulatory red tape, and they have a highly leveraged balance sheet that offers almost zero margin for error.
It tests the fundamental time horizon of anyone looking at this equity. Like, are you trading the anxiety of a 1 to 2 week regulatory headline?
Right, or are you investing in the undeniable structural cost advantage of a bottom quartile producer?
That tension is exactly what makes earnings season so compelling. Right now, the market is voting with fear over the short-term liquidity crunch in the halted machines.
Which leaves you with a final, broader strategic question to mull over. If Sigma's margins are this incredibly resilient and they are executing to the absolute highest quintuple zero environmental standard,
Yep.
yet they are still facing brutal operational halts and regulatory hurdles, what happens to the rest of the industry?
That's a great point.
If global environmental red tape makes it nearly impossible for new competing lithium mines to ever come online, could this current regulatory headache actually be proof of a permanent moat?
Wow.
Think about it. Once Sigma finally resolves this local Brazilian dispute, the exact same red tape that is choking them today might be the exact barrier to entry that prevents any new competitors from ever challenging their market share.
It's a dynamic worth watching very closely as they negotiate this restart.
Absolutely. Make sure to follow the show for our daily earnings coverage so you never miss a deep dive into the numbers driving the market.